Good morning. It's June 8th. We're out here on a Thursday, and I want to talk to you a little bit about some of the Chinese data that came out. This week we received data on China's imports and exports. The country's May exports declined by around 7.5% annually year over year in May. That's the first time since 2013 that it declined in May month to month. But similarly, China's imports declined by minus 4.5% year over year, which obviously was down, but better than feared. People were worried to be down 8%. And we wrote a Longbow arrow note out this week about it, but I think that it's helpful to kind of go under the hood and talk about some of the meaning. And I think ASR put out a really interesting piece putting these moves in perspective as companies and countries around the world are reshaping their global value chains. They make the point that China is happy to let low value add processing and assembly production move out of China to Southeast Asia. So it makes sense that imports that are usually for inputs for this type of processing and production are down over 16% year over year in May. And this really compares to only a minus 0.6% fall in ordinary imports. So if they're doing less of this low-end manufacturing and putting it elsewhere, obviously they don't need all the components for that type of manufacturing. So it doesn't mean that they're losing all of their value out of exports, though. In fact, China's exports of intermediate goods, so further along the chain to Southeast Asia, have been on a tear, and they echo trends seen in U.S. imports of final goods from from Southeast Asia to the U.S. ASR linked this to similar developments that occurred back in the late 1980s amongst Japan, Southeast Asia, and the US after the US put restrictions on Japanese imports. So we were more worried about Japan back then. Now we're more worried about China. But when you look at growth areas like EVs, China's really gaining market share in its exports. And they have the largest domestic market for EVs, which is supported by production and consumption subsidies, in addition to a government-financed charging station map. So coupled with Tesla entering the market and providing additional competition, all of these dynamics are really making China strong. So we can't look at those numbers and say, oh, their imports and exports are weak, therefore they're having a tough time. No, part of this is a strategy that they're doing. China's becoming less resilient on imports of manufactured goods. So imports of them as a share of GDP have fallen to the lowest level in more than 30 years per ASR. But it's happening at the same time that the export of manufactured goods as a share of GDP has been rising since 2020. So they have a trade surplus. China's surplus in the trade of manufacturing goods as a share of GDP is back to its 2009 level, even though the trade surplus is only back to its 2015 high. So why should you care, right? I'm telling you these things. Why do you need to know? But the dynamics could cool inflation. So when you subsidize production, it can benefit the buyers, right? But also if China's focused on more value-add manufacturing, it's going to be a little bit more competitive for countries like the US and other folks in the EZ to be boosting that demand, the domestic manufacturing for external demand, because they're producing things internally, we're producing things internally, so you're probably going to make less money if everyone's doing that, and it might be more expensive. And if more companies and countries move away from needing cheaper, lower-end manufacturing in China, interestingly, China's power could be reduced. So don't just look at these headline numbers. Underneath the hood, you might be seeing it reflect strategy more than simple macro trends. So that's, I know, a pretty long talk with you before we get to the Longbow dashboard. But I wanted to talk about that because, as you're thinking about a lot of the macro data, what does it mean is about Chinese slowing growth? It might not be. It could just be strategy. But today I wanted to point out one big thing on the Longbow dashboard, and that is Doomsday Dozen. We're at 90. We're at 90, folks. And so you got to put that in perspective. I will show you a map of the signal history versus SPY. I'll probably put that out on Twitter today, maybe LinkedIn. But it's really important to know, once you get to that 90, 100 level, make sure you're taking care of your portfolio. You've got risk management on. Not to be time to be loading into new equities or risk assets. So be careful out there today, and we'll catch you back tomorrow.